Hey everyone, hope you're having a good week. In this video, I want to show you a systematic day trading strategy, a really simple one that I've developed. I tested it on the Nasdaq using 1-minute candlestick charts for the analysis. Its cumulative return over time, representing the total profit accumulated, is shown here. You can see the profit factor here, the maximum drawdown, how many trades it generated, the overall success rate, and the risk to reward ratio, and the average number of trades executed per day. If you wish, you can also pause the video and take a closer look at all the detailed metrics presented here. All right, so right now we're focusing only on the middle line, okay? Okay, it's either green or it also turns red if the price crosses below it. So this is the VWAP. For those who don't know, that's volume weighted average price. It's simply a moving average that's weighted by the volume at each price level. And the VWAP is recalculated each time. You can interpret it like this. If the price is above the VWAP and you want to buy, you'll probably be buying at a premium, okay? You'll buy at a premium. Why? Because the price is above the fair value. If the price is below the VWAP, you're buying at a discount because the price is below the fair value. Okay? So a price that is, so to speak, quite far from the VWAP, right? It will tend to return to the VWAP, okay? Basically, the price tends to return to the fair value, okay? It's a kind of classic mean reversion, okay? From a probabilistic standpoint, the price has a higher probability of being at its average, okay? If, let's say, the distribution is a normal distribution, right? Then the price has a higher probability of being at its average than a few standard deviations above or below its average. If we assume the distribution is a normal distribution, okay, then the price has a probability to be found more at its average than at several diverges above or below its average, okay? It's a matter of probability. If price had a normal distribution, then we would have solved the stock market. So why did I enter? I want 90% of the last 20 candles to be above the VWAP. That's the first thing. Second, I want the price to come down and touch the VWAP bar. The moment it touches it and my cumulative delta is positive, which I'll expand on briefly now, I enter a long position now. Okay? I enter a long. When do I take profit? I basically use a trailing stop based on the volatility in the market. My stop is trailed based on the market's volatility. Now, regarding the cumulative delta, for those who don't know, by definition, delta is simply the volume of the ask minus the volume of the bid. Okay? Or in other words, I won't get into that now because that's already order flow. In other words, if my delta throughout the session is positive, my cumulative delta is positive, it means there were more aggressive buyers than aggressive sellers. Or in other words, there were more buy market orders than sell market orders. Or in other words, it means that right now there are more participants who want to push the market up than participants who want to push the market down. Okay? So it's also important for me to see that we're in a bullish day. Only on a bullish day, when there are more buy market orders than sell market orders, will I enter a long. Okay? All right, so let's go to the code a bit and take a look. So the code is relatively simple. Okay? Basically, this function gets called every time there's a price change. Okay? It's not every time there's a new bar. It's every time there's a price change because I defined it here. Okay? My calculation method is on price change. Now, every time there's a price change, I check this Boolean condition. Of course, I also check that we're not already in a trade. Okay? After that, I check this Boolean condition. If it equals true, I enter a long. Otherwise, I manage my trade. Okay? If I'm already in a long, I want to manage the trade. So basically, the price needs to be at the VWAP. Okay? It needs to touch the VWAP or be less than it. After I already know that, of course, 90% of the last 20 bars were above the VWAP. The slope of the VWAP needs to be positive. It's simply the current value of the VWAP minus the previous value of the VWAP, okay? So I subtract the two, and if the result is positive, it means the slope of the VWAP is positive. I also want to see that my cumulative delta is greater than 0, which means there are more buy market orders than sell market orders, okay? And here I'm basically checking that 90% of the candles of the last 20 candles are above the VWAP, okay? If all of this happens, I enter a long at market. Now, if I'm already in a trade, I want to manage it. I want to manage the trade, okay? So if my position is a long, right now I've disabled the short, so it doesn't matter. It's only for longs. If I'm in a long, that's great. I want to see that the price actually crosses below my trailing stop line. If it crosses below the trailing stop line, okay, which is based on the volatility in the market, specifically on the ATR or average true range, then I exit the long. So that's the strategy. I hope you enjoyed the video and all in all learned something here. Thank you very much and have a great week.